Hello, everyone. Welcome to our webinar this afternoon, I should say. I'd like to introduce myself. My name is Julia from the Birchal team. Before we jump into this session, I would love to acknowledge the traditional owners of the land I'm joining from today. Birchal is based on the lands of the Wurundjeri people of the Kulin Nation, and we pay our respects to their elders, past, present, and emerging. Today, I am joined by the Savana team. Very excited to hear the pitch from the team today. The session will initially start with a pitch from the team, and then we will go through a Q&A at the end of the session. So as you are hearing things, think of those questions, write them down in the Q&A section. That'll be great. I'll moderate that session, part of the session at the end. And for context, Birchal, we're working with Savana on this crowdsourced funding offer. Crowdsourced funding, CSF, equity crowdfunding. For those of you that might ask, what is it? It's a relatively new form of fundraising here in Australia, and it allows businesses to access funding from a large number of retail investors, and really lets the community vote for what we believe is important. So we think it's a really fantastic fundraising opportunity. Our role at Birchal is to be the licensed intermediary for the offer. So the information and discussion in this webinar is for informational purposes and should not be considered as advice or recommendations to invest. Please do your own research. And always consider the offer document and the general CSF warning before investing. So without further ado, I will hand it over to the Savana team. Looking forward to hearing from you all.
Thank you so much, and good afternoon to everyone who's joined. Thank you so much for showing your interest in our business. We really appreciate it. I'm Mark, and I'm the CEO of Savana. I'm joined by my colleague Samuel to my right and James to my left. They're going to help me on the slides, and they'll chip in if there's any sort of questions that are directed to them. So onto the first slide as to who we are. I just want to create a little bit of context here. We are an asset manager, and what that means is we produce funds as a business. We exist to grow your savings, and we charge a fee to grow your savings. What makes us different is we like to think of ourselves as an active asset manager. That basically means we try and beat the market. If you contrast that to a passive manager who just tries to match the market and track it. So in essence, we exist to grow your savings faster than a passive fund. Just to clear things up, off the back of some feedback, is this is about investing in Savana, the company, and not Savana's funds. So just to create the context, they're very important. Keep that in mind. So introducing Savana. So at Savana, we believe in using tech instead of investment teams, right? So we value stocks and build portfolios using technology. By design, we have no investment team and no middle office. Right? This is to drive massive cost efficiencies. So if you contrast that to traditional funds management, which is a people business where you've got investment analysis performed by very smart, highly skilled individuals, poring over information and data on a Bloomberg terminal, we don't do that. That's where we differ. So now onto that traditional operating model, because it's had some mixed results recently, and the problem in active asset management is actually an open secret. So let's quickly have a look at the problem with active asset management. And this is what we set out to solve. So beating the market is the exception. It is exceptionally difficult. I don't mean this as a bad thing to any managers out there. I recognize how tough it is. As an example, in the US, 90% of fund managers underperform the S&P 500 over a 15-year period. In Australia, that figure's closer to 85%. Relative to the ASX. So there is a problem. A lot of people are paying fees, and those managers are struggling to deliver the performance to make it value for money. So I mean, we're obsessed over this question, right? And we try to figure out what's going on here. And it's sort of, why are so many of these managers underperforming was one, and two, what separates the 10% that are outperforming from the rest? And we narrowed it down to sort of 5 key reasons. The first is a lack of differentiation due to what we call generic investment philosophy. So your investment philosophy kind of drives how you view the world. That is your worldview. It's how you perceive information to arrive in some sort of conclusion, right? So how you frame information determines what sort of stocks you're likely to pick. Now, if everyone is framing information in the same way, that leads to something called crowded trades, and that's not very good. That means you don't really have an informational edge, and you're basically playing a game where you're competing only on price, right? You're not differentiating your portfolio at all. Um, and that also hurts you in terms of your performance. So number one is lack of differentiation, and that's driven by the investment philosophy. Number two is we notice scalability constraints. Even if you did have a different way to see the world, right? Often there's only 8 hours in a day, and it's very difficult to scale that across a reasonable universe of stocks. And so what of that is it limits the amount of opportunities you end up finding. Um, and if you're really pressed for time, you don't really get enough time to do the research you need to do at the level of depth required to get to the right decision. So you start to make mistakes. Again, that starts to hurt your performance. The third thing we noted, and it's personally given a couple of managers in Australia recently, is key person risk. Often the secret sauce we find with a lot of the managers is they've got one portfolio manager who's a superstar, and that person holds the secret sauce. And as soon as they leave the building, for whatever reason, the performance disappears with them. So a key part in terms of offering someone a long-term performance on your product is to make sure that you can keep a key person in or abstract that, which we'll get to in a minute. Then there were two last reasons were more sort of pernicious in nature because you don't really notice them explicitly. And the one is behavior. Even if you get to the right decisions, behavior lets you down so often in this space. We're all susceptible to fear, to greed, to panic. And in this game, if you've got the right decision, acting on that is actually very, very difficult, right? And a lot of managers under emotional pressure make the wrong decisions, even though they know what the right decision is. And again, that costs you performance. So in that, we have to bring that into our process to try and help. And the final one is managers become victims of their own success. Now, the irony is managers grow and their funds grow, and those funds grow to become so big that they trade off performance. They start to look and act like the market, and buying small and mid caps or whatever it might be just doesn't make a difference to their performance anymore. So the performance gets traded off for their management fees. And the incentive to put that growth of their business over and above the value proposition to the investor just drives the wrong incentives at the end of the day. So it's sort of a key principle you've got to make. A key choice you can make up front is, do I want to let my products grow and grow and grow, or do I want to limit the size of my funds to preserve performance? And we'll get to in a bit. We've chosen the latter, which is a tough choice to make up front, but we believe it's really important in maintaining sustainable performance. So bearing those lessons in mind, what makes us different? So we think of this in two ways, because this is really touching on competitive strategy. The first is, where do we want to play in the market? So where is our edge strongest? We see that as small to mid caps, and we'll get there in a second. The second part is we think about if we're very good at delivering products for small to mid caps, how do we want to design that product? How do we want to construct it? What activities do we want to do that we're going to do differently to everyone else? So we're very difficult to copy, right? So as an example, I've highlighted our US fund. So our US fund is a typical example of how we've targeted something that we call an overlooked niche or a high alpha niche. Our US product was listed in November, and it targets small to mid caps. Since inception, it's done about 30% relative to its benchmark of about, call it 9, and it's outperformed north of 20% per annum, which we're very, very happy about. What makes this so attractive to us and so unattractive to others is that this area of the market consists of thousands of stocks. Small to mid caps in the US is thousands of stocks. That's very difficult to research if you only got 8 hours in a day. And if you're a larger manager out there, if you're going to spend the same amount of time researching a small cap versus researching Apple, you'd much rather research Apple, because the one can be $1 billion position in your portfolio, and the other one could be a $10 million position in your portfolio. And that smaller position, even if it triples in value, is not going to be the difference maker for your performance. So the so what out of this is This means that this part of the market is structurally under-researched, which then leads to mispricings. And that's our opportunity, because our edge is using tech to mass value calculate across the market, right? We are valuing 40,000 stocks or more every single day, right? So we use that ability to target that sector. What that does is it just services far more opportunities. So we see a higher frequency of opportunities and higher quality of opportunities surfaced. Right, so that's where we play. Now, how we like to win. And this thing is how we think about building a product that others wouldn't or can't. And from this perspective, we re-engineered a fund manager from the bottom up, right? And there's sort of three things we knew we had to do here. The first thing is we needed to see things differently such that we could choose stocks that others wouldn't. We don't want stocks in our portfolio to overlap with our peers, and we want it to look very different from the benchmark, right? That means we should have different performance and outperformance, and to give you some diversification, right? That's fundamental. Two, we need to behave differently. That means we need to apply our algorithms such that we can truly be contrarian. We need to buy when others are selling, and we need to sell when others are buying, right? That's very difficult for a human being to do emotionally, right? If you're buying a stock on the way down to lock a low cost, it sounds logical in theory. Go try and do it. It's very, very difficult emotionally. So behaving differently is an important capability. Finally, we need to be tech-driven. And we need to be tech-driven because that gave us scalability. And scalability gives us economies of scale, right? So we want to be low cost in this. Having a low cost means we can run our funds at very low break-even points, and we can be profitable at smaller portfolios. And that's important. If you want to preserve performance, you need to be profitable at smaller portfolios. So let's just double click quickly. I want to give you guys a bit of a flavor as to how we see things differently. We follow an investment philosophy called Medi-Models Science. This is a branch of something called collective intelligence, and this was pioneered at the Santa Fe Institute. Now, the promise that Medi-Model Science makes is that groups make more accurate predictions than individuals. This is known as the wisdom of crowds, but what it also says is that if you incorporate many different models with different perspectives, the prediction that all those models will make on average will be better than any single model, right? And this has got a very intuitive reason behind it. The first reason is that all models are wrong. And the second reason is that all models are oversimplifications. They have blind spots, they miss things. So when you combine models, you create nuance, you highlight different cause and effect, and you develop more accurate predictions. And you also identify stocks that perhaps others wouldn't look at because it highlights something that they haven't seen, right? So that's how we see things differently. The other thing I want to double click on is our tech. So if we can move to the next slide. This is important to understand is Yara is our investment team, and there is no investment team. There is a tech platform that is valuing stocks every single day, right? It's the first thing I need you to take here. The second thing is the goal that we set up was we wanted to build a funds factory. We wanted to be able to take a whole bunch of data, call it 40 to 60 terabytes of data on the one end, and then process that to manufacture portfolios on the other end. And to do that every single day at low cost, because we want to manufacture funds at low cost and maintain them at low cost. The other thing I want to highlight that we got right about this process is we managed to convert our investment philosophy into code. Now, this is very important because you can't always take every investment philosophy and convert it into a maths equation or into code. There's no guarantee you can do that. But if you can do that, you open up to scalability through technology, right? And that's very important because we got that right there. That made this a scalable process that also got rid of key man risk, because now we've taken all of that IP and we've managed to capture it into repeatable code. Onto the scalability, this is what gives us our advantage, is we can do mass valuation calcs through this. We're doing almost, as I said earlier, more than 40,000 companies are being valued every single night. That means the cost of us valuing any single company is very, very low, right? That then translates into low-cost portfolios and low break-even points. Now, as I touched on earlier, if you want to preserve performance, you need to keep your funds smaller. We can do that because we have lower break-even points. So we're happy to manage a fund that ends up being $100 to $150 million, provided it's got the performance and provided our break-even points low, we can maintain profitability. And we see that as a moat in itself. We can go to the next. So where are we now? To the next slide. We've basically spent the last 10 years building this. This didn't happen overnight. We had to develop IP, we had to test it, we had to build the tech platform, we had to get the funds validated externally with ratings agencies, and all of that led to us launching our first fund last year in November, which is an active ETF on the ASX under SVNP. It's based on a US small cap strategy. So during these 10 years, we built a suite of funds that we want to launch. And the context is that we've now built this inventory of funds up. We want to launch multiple funds and we want to build out our marketing distribution. So you're probably asking at this point, and the right question is, okay, that sounds great. You've got these funds to launch. What is this ETF opportunity? So let's take a look at the next slide. We think the industry is very attractive, and we think it's very attractive for a very simple reason. Demand exceeds supply, and it's likely to stay the case. So on the demand side, we can see that ETFs are a rapidly growing market. It's already a very big market at $300 billion, but it's growing at a rate of 25% even this year. That growth is underpinned by very good reasons, and that's what gets us excited. The Australian economy is still expected to grow. As long as the economy grows, we'll still see the savings power of individuals grow. The other part of that we think is very attractive is the super legislation is increasing to 12%, and we think that's going to 4x the amount of super in the country over the next 20 years, right? Super is already worth trillions of dollars. You can just imagine the size of that. So the point is there's a big savings power that is growing a lot, and there's just not enough supply that can meet it. Now, on the supply side, we are a manager. It's actually very difficult to become a manager, right? You need a lot of capital. You need a lot of regulatory licenses in place. You've got to develop track records. You've got to get onto approved product lists or platforms. There are major barriers to entry, and the so what out of that is it limits the number of new products coming online. So that gives us a window of opportunity to build an active ETF brand. You would have seen, for example, Beta Shares over the last 15 years managed to build a very good passive ETF brand. We think there's an opportunity to build an active ETF brand, and we think that opportunity is now, because we're not the only people that know about this. There are a lot of other smart people out there that are seeing the same opportunity. There's one other thing I want to touch on here that we discovered whilst going through this process, and it's a bit of a sweetener to all of this, is that people are changing the way they invest. This is a big generational shift. You're seeing Gen X, Gen Z, and millennials bypassing financial advisors and buying stocks and ETFs themselves. We don't expect this trend to stop just because financial advice is very expensive to most people in those generations. But the sort of so what that comes out of that is, in this industry, a lot of the players that act as middlemen take up a lot of the margin, right? So when you can go direct to this audience and build an audience on a direct channel, there's savings to the investor, and we don't give away a lot of margins as the manager, right? So we end up being more profitable. It's a win-win between us and the end investor. And we see that opportunity growing. If you're looking forward 10 years and working backwards, right now the market's controlled by 85% financial advisors. Even a shift of 5% would be a massive opportunity. It's a $2.5 trillion market. So if you're looking at 5 to 10% of that, you're talking $200 to $500 billion, right? These are staggering amounts. So we're busy building up that channel, and that's partly why we're working with the Birchal process here. So I just briefly want to touch on the long-term play of the inventory that I spoke about earlier, so our suite of products. We've highlighted 20 products here. Overall, we're very, very happy with their performance. We've got an average alpha of 11%. We're also happy about the capacity that these portfolios could run at. Remember earlier, I spoke about us being very controlled with how we size our funds. During that analysis, we try and see how big each fund could get. And we know that these funds could support about $6 billion of FUM. we'll look to launch all of these performing products across various geographies over the next few years. And if you try and price that just to get an idea of what they might be worth, that's probably anywhere between $50 to $100 million worth of fee revenue that size of funds could generate. So obviously very exciting, but we've got some work to do. So onto that work, let's look at the near term. At the moment, we have a US fund, which obviously we're very happy about, but we do want to proliferate. We want to show that we can do this and we can scale quickly. Our Australian fund has been performing well, tracking about 15% per annum. That's also focused on small to mid caps. The same as our global small to mid cap strategy is tracking at 19% per annum. We want to launch both of those this year, ideally. We think both of those are relevant to launch at this point because we see a lot of home bias in Australian markets. Australian investors like to invest in Australian funds and stocks. And Australians also like to invest in global funds for diversification as opposed to single geographies. So that's what's driving the thinking behind those two funds being launched. So I'll ask, why are we speaking to you today? Sorry, Rasconi, if you could shift. We want to build a distribution channel through our shareholders. The goal here is we think we can get to an audience size of 1 million. Just looking at everyone's social networks, we think that generally people have 30 to 150 close connections, call them tight connections, highly trusted connections. And beyond that, probably up to 1,000 on average, looking across your Facebook, LinkedIn, Instagram, you name it. So our whole idea here is how do we use Birchal and our shareholders to build up a base of brand ambassadors with a captive audience? We want you to talk about our business at barbecues, right? We want this to be a conversation starter. At this point, we're a new brand. We've got to get out there, and this is about us building PR. Thank you.
Great. Thank you so much. That was fantastic. And just a reminder to the audience, any questions that you've had throughout the pitch, please type those into the Q&A section. You'll see a little speech bubble on the bottom right of your screen with a question mark, and you can submit your questions that way. I will start to read through some of the questions we've received and hand them over to the team now, but please keep them coming. That was a really, really fantastic pitch, so thank you. So obviously you've made your ask really clear, which I think is fantastic. You're also obviously here on the Birchal platform and having this discussion to raise capital as well. Can you tell us how you plan on using that for the growth of the Savana platform?
Absolutely. So I think it's very important to put the context here. We've got these products ready to launch, and it's about commercializing them. And that means we need to invest money in building the brand, right? We've got to build brand awareness first, build track records and trust, and launch those products, right? So the bulk of the money will go into funding those product launches and funding the marketing and distribution.
Great, thank you. And can you tell us a little bit more about the Savana team?
Sure. So as you can see, I've got my associate director, Samuel, next to me, and I've got my portfolio manager, James, next to me. They've both been involved with Savana for many years. Rasconi has been here for 5 years already.
Yeah.
5 years from the inception, working on the tech, helping build up the IP, managing all the portfolios. Samuel joined even before that, perhaps, right?
2018, I think.
2018, he was also crucial to testing a lot of the IP early on, figuring out, what is the optimal time to rebalance the funds, testing various hypotheses around all the different models. Beyond this, who you don't see today, of course, is our CTO, a guy by the name of Sanj. So Sanj has previously worked at Deloitte, and he's helped scale up and build many B2B SaaS companies. His focus was on assisting Deloitte's VC fund, so he would help scale up those companies within Deloitte's VC fund itself. So very lucky to have him on board, and he brings a skill set that is very focused on business models relevant today. So how to use AI agentic frameworks, or the stuff about building the architecture to manage data pipelines very well, driving efficiency around them, and adding layers of ML to it. Sorry, I mean, not use machine learning to it. So in terms of the skill set, like, we don't look much like everyone else. There's no, as I said, there's no big middle office. There's no massive investment team. Just in terms of the context where we would want to look at moving ahead, I think where we'd look to add to the team would be around distribution. Whereas we do want to target going direct to customers, and we will do that. We've got to be cognizant that majority of the market is still controlled by financial advisors. So where we look to hire business development managers with those sort of relationships with financial advisors. And that sort of person would, go and drive a lot of the events and investor conversations.
Great, thank you. I've had another question come through about the deal structure itself. Are the shares ordinary shares or crowdfunding shares? What is the structure? So for a CSF campaign, that's a Birchal question, but they will be ordinary shares. You'll see more information on the structure of the deal come through in the offer document, which is being prepared by Savana, which will be shared with you once you've registered your interests. So that is the answer to that question. I've got a question coming in here, which I'll read to you. A performance of US small caps ETF appears to have had challenges in tracking above index since launch. Obviously a challenging market during that time, but just wanted to get your thoughts on the performance since launch.
Yes, that's absolutely fair. Look, we've seen this before. Unfortunately, we can't publish our full track record online. You've got to go click through another link. But we've previously had downturns, and what the algorithm does, because we're contrarian in nature, is we generally do lock in these positions on these corrections. Part of what it does is where stocks are undervalued, we'll buy on the way down to lock in lower costs and then hopefully sell as they reach back to intrinsic value. As to saying what happens to Trump and his tariffs, I'd obviously hope that we get a couple of wins over the line soon, where you see some of the US allies coming to the table and making deals. I think the longer this all goes on, there becomes a bigger structural risk to the economies. And that's, you got to watch out for the escalation between China and the US on that front. I think the other deals will have a good chance of getting done. With small caps and mid caps specifically, it's very interesting in the US in that a lot of those companies mostly sell to Americans only, and a lot of their supply chains are actually in the US, whereas a lot of the large cap companies are global in nature, right? And that's why you've seen a lot of pressure on prices with the Magnificent Seven and a lot of the S&P 500. So a lot of that price correction you'll see in small to mid caps is more just general risk off trade. You're looking at companies that don't have a lot of liquidity. So when big managers need to get out, or big pension funds, you see corrections that are obviously a lot more volatile than you would on large caps.
And just one other point I might add on that. Thanks, Mark.
Yeah,
just a general point on the market. There's a lot of fear at the moment, and there's a lot of indiscriminate selling. And our strategy relies on value being recognized over the long term. So I think a lot of the performance we're seeing is not necessarily rational. It's and it may be divorced from the actual fundamentals or profile of the stock. So I think in a scenario of indiscriminate selling on the market, that means that a lot of the selling you see isn't actually reason based. So I think over a longer period of time, that's when we hope to see recovery.
Absolutely, yeah, agreed.
Great, thank you. Keep these questions coming, audience. They're very good. What time frame would investors expect an ROI?
So you're actually asking about exit, yeah? So there's a bunch of options for exit. The most likely exit for this business would be to a strategic. Of course, if we've got a bunch of products that perform well and can be launched, a massive accelerant to our business would be partnering with someone else, right? If you already have distribution and you've got billions of dollars of FUM, provided our products don't cannibalize your products, will be very attractive to a strategic. So that's something we would actively look at, and we'll look at anyway, just to accelerate the speed of growth in our business. Where you can find partners that can sell your products, that's a smart thing to do. Of course, all of the other traditional avenues are there. If there was a private equity house interested in buying a manager, that's often the case. These are attractive businesses because they have relatively stable revenue streams. I like to call them the old software as a service, right? Because they're annuity based. So that's always a good route. If we did manage to build up a very big shareholder base via Birchal, you could always look and ask the question, is going public interesting? I don't think public shareholders are the worst idea. They tend to be more long-term focused. They might be better holders than, say, if you approached some of the more short-term focus being a, say, for instance, a VC investor. But in terms of time frame, we'll be opportunistic over the next 5 years, but generally, I think we're trying to build this business, and we're going to need some time to establish track records. Most people you speak to in fund management space believe you need to have at least a 3-year track record across a lot of products, and this could be public. So I think we need to build it up first, get the credibility. We've already got a couple of ratings. We'll continue to get that done, get the track record going, and then you can in earnest start to have those conversations. But if I were investing in this, I would have a medium-term outlook on exit.
Great, thank you. How do you, or how will you incorporate AI in the programming of the investment platform?
Great question. And this is our bread and butter. On constructing investment portfolios, we don't use off-the-shelf AI. We've built our own proprietary models. The reason being on that is, I think if you, someone else out there, and you've got the same data set and you are using off-the-shelf libraries, I worry that you might end up making the same portfolio choices as everyone else, right? So I worry that you don't differentiate. So on that thing, we stick to many model science. A lot of what we do creates models based on probabilities, and probability distributions can be trained. If anyone's au fait with machine learning, yeah, you can train probability distributions to maximize your true positive rates, and we've tried that before. So on our portfolio construction, we try to stick to our thesis and philosophy. We don't want to have any style drift. On portfolio management, so once you're trying to sort of oversee the portfolios, there's a lot of maintenance costs that comes with that, right? And we've got, north of 100 funds running as inventory. And every single time there's a key event that comes through, an exception, an M&A transaction, a 10% price movement, you want to track that and figure out why. And what we try to overlay there is that's where we're applying agents. And this is where Sanja's doing a lot of work at the moment, is letting a set of agents ingest a bunch of news data about your portfolio and then create trigger events and workflows to manage a lot of that work. So that's work that currently we're doing, and a lot of that work is sitting on James's table at the moment. We're trying to automate that part out. The other part we're trying to work on is, a lot of people don't see this, but there's a lot of work you got to do on trading, right? Actually executing the trades. And a lot of that becomes accounting in nature, right? So every single time you do trades, you need to make sure that you've done all your compliance checks. You've got to make sure that all the orders go off. They use the right trading algorithm. You've reconciled those trades afterwards. And every single day you've calculated your net asset value of your fund such that by the time it goes out to market, everything's accurate, right? You want to make sure the price per your units on the ASX is right. That's extremely important. And there's a lot of work in that itself. And a lot of other fund managers have got, we know fund managers have got 60 to 100 headcounts. Half the headcount are sitting as accountants actually working on that in middle office. So we're using tech, one, to capture all those transactions, to create those workflows, and then applying agents to check that, to manage a lot of those exceptions, to take away from our own workload. And that's sort of the future. If you're working backwards from even 5 years' time, given what we all know today, if you're not applying agents within your business, I think there's a good chance people are going to have a cost advantage against you. So you just have to do that. That's sort of meat and potatoes at this point.
Yeah, it's a massive part of getting the middle office, that whole, process automated. You take AI agents and then they go off and do a lot of that hard work that would require a massive team. So yeah, it's pretty important for us.
Big savings.
Yeah.
Great, thank you.
And it's good for risk management,
Mm.
right? Because you can track all of it.
Yeah.
Thank you. That's really interesting. We might wrap up with one final question, and probably less less about what you've built so far, but more about the future. And look, how do you plan to, and or intend to communicate with your investors and ambassadors moving forward? How do you foresee a strong relationship there, or how are you thinking about that?
So I would like to do that on a regular basis, at least once a quarter, because I think we miss a trick if we don't communicate often, because the whole point here is we want people to be able to share knowledge about our company, right? So we've got to drive the conversation. I would look to try and do Zoom calls to get everyone around, and where we can do events too. I think if there's any learnings from very successful companies is they always speak to their customers. And although our shareholder is not our customer in this case, they may well be. And I think we can get a lot of very good feedback around products on that. So let's even take an easy example. Which products out of our suite should we be launching next, right? Or where are people disappointed with the current process? What did they think about active ETFs? What didn't they like? There's huge value in that. And I don't want to miss out on that.
Great, that's fantastic. Definitely a lot to be said from listening to the customer. So that's great to hear. Well, look, thank you so much for such an incredible presentation. And thank you to everyone who's joined today on the Q&A. A recording of this session will be sent to you afterwards. If you would like to go over it again, or for those that will be watching this recording later. Please also remember that the expression of interest for Savana is open now. I believe we have about 12 more days left of that open. So if you haven't already, please register. You can jump onto the Birchal platform, check out the pitch video, check out the company profile. Registering for this EOI will give you early access to the offer campaign, which goes live on the 29th of April. So make sure you've done all of that. Thank you again to everyone for joining and the Savana team.
Thank you. Thanks
Thank
for the
you very much.
opportunity.
Thanks,
Thanks,
guys.
everyone.
Take
Cheers.
care.
Bye.